What up, guys, and welcome back to another video. It's Jay Manchin, of course, and today we're going to be discussing the Fed minutes. Now, if you're unfamiliar with the Fed minutes, it's effectively a breakdown of the most recent policy deciding meeting, which is released 3 weeks after the meeting. So this Fed minutes is for the May 6th/May 7th meeting, to give you an idea. And of course, there are some things that stood out to me, so I wanted to kind of go through those really quick. So without further ado, let's jump into it. Now, the first thing that stood out to me is they were looking at the idea of flexible average inflation targeting, which we discussed 2 weeks ago in my video that I released 2 weeks ago, obviously. So it says here that participants discussed the advantages and disadvantages of flexible average inflation targeting, under which monetary policy seeks to make up for persistently below objective inflation to achieve average inflation of 2%. And flexible inflation targeting, under which policy seeks to return inflation to 2% without making up for the previous deviations from the target. So once again, as we discussed 2 weeks ago, that's just allowing it to run above or below the 2% target so that over time it averages out. And they go on to say that participants noted, however, that the strategy of flexible average inflation targeting has diminished benefits in an environment with substantial risk of large inflationary shocks, or when ELB or effective lower bound risk are less prominent. So they're effectively saying that flexible average inflation targeting benefits will be diminished in an environment such as the one we're in right now, when it is very tariff driven or uncertainty around the tariff impact that we have yet to see fully. So for example, they could let inflation run above that 2% target, but unknowingly at the same time in which we're actually starting to have those tariff impacts feed into the actual inflation numbers, causing inflation to be higher than they thought when they initiated the flexible average inflation targeting. So basically, it could end up causing way more inflation if they were to employ a flexible average inflation targeting while tariff impacts are feeding through the inflation numbers. Now, they did note an increased probability of a recession in the next 6 months, but we'll come back to that because this isn't the only time they mentioned that. They also noted that the dollar depreciated against other major currencies, so I guess the Mar-a-Lago Accord is working. And they also touched on the bond market weakness that we're still experiencing today. So it says here, measures of Treasury market liquidity deteriorated immediately after the announcement of higher than expected tariffs on April 2nd and partially recovered later in the period. You know, sometimes I wonder if they take implicit shots at the president in some of these press releases, because they're talking about Liberation Day. Effectively, we started seeing Treasury market weakness on Liberation Day. That's effectively what he's saying. And so, in a sense, I wonder if that's like a way of formally taking a shot at Donald Trump and say, hey, bro, this is your fault, actually. All this weakness that we're experiencing in the Treasury market, it's because of you. Maybe they ain't thinking that deep either. So, honestly, given the uncertainty around tariffs, as well as deficit fears, I really don't know where yields are going to go from here, so just going to keep an eye on it. Now, they also noted that inflation remained elevated but lower than their levels from the same month a year earlier. And of course, the labor market is still solid, averaging 4.2% on the unemployment rate, and that's the second half of the year average for 2024. Now, them discussing GDP in the first quarter GDP numbers is what actually stood out to me the most outside of a recession, right? So it says here, according to the advanced estimate, real GDP declined slightly in the first quarter. However, this first quarter estimate was likely affected by measurement issues. And they go on to explain, real imports of goods and services soared in the first quarter, likely driven by front loading of imports, especially consumer goods, ahead of anticipated tariff hikes. Given relatively tepid export growth, the net exports category made a large negative contribution to measured GDP growth in the first quarter. Now, they're basically saying that GDP declined not because of some real decline in economic activity, but because of a massive front loading of imports because of the anticipation of tariffs, which caused an imbalance between imports and exports, which fed into that negative GDP number. So they're effectively saying that the first quarter GDP numbers was a fluke, but they're still expecting a recession in the next 6 months. Anyway, moving on. Now, another thing that stood out to me is them talking about the difference between large and small banks and how they're responding in this environment. And I think it really highlights the difference between risk appetite between the two. So it says that large banks reported easing lending standards or leaving them unchanged for all commercial real estate loan categories, while smaller banks tightened standards or left them unchanged. So you can see that the smaller regional banks are preparing for things to deteriorate quite a bit, especially on their lending side. And we do have $1 trillion of commercial real estate loans coming due. This is what you call a maturity wall in 2025. And so we'll either get what we had in 2024 in terms of extending and pretending, or we'll see a wave of defaults coming through the commercial real estate sector, but we shall see. They also acknowledge that housing valuations remain quite high amid increased risk to the economic outlook and the appearance of ebbing risk appetite. So although I don't see a huge decline in home prices coming down the pipeline anytime soon, it's hard to believe that an asset class can just go straight up forever with minor price falls. And so sometimes elevated valuations are enough to warrant someone to think that we're going to experience a collapse in that asset class. They are expecting the labor market to weaken substantially over the next 18 months, but it doesn't seem to cause for concern in terms of adding to the recessionary pressures. So here they touch on risk of recession again. So it says, risk to real activity were seen as skewed to the downside, and the staff viewed the possibility that the economy would enter a recession to be almost as likely as the baseline forecast. Basically saying that a recession, according to the staff of the FOMC, is baked into their forecast damn near in 2025. And then it says, overall, participants judged that downside risk to employment and economic activity and upside risk to inflation had risen, primarily reflecting the potential effects of tariff increases. So all the downside risk is basically because of tariffs. So it's all Donald Trump's fault, basically. Anyway. And there was no dissenters here in this decision at all. Overall, this is a confirmation that the Fed is in no hurry to cut rates, especially during a time where there's a ton of uncertainty around the outcome of tariffs and the impact of tariffs. The one expectation is that they're going to cause a ton of inflation. And so that definitely warrants a pause from the Fed. Now, we could end up in a position, let's say a recession does come upon us, and the Fed does have to cut rates to spur on economic activity, which puts upward pressure on inflation. Well, if tariffs are already putting upward pressure on inflation, and then you have rate cuts, well, we're going to start seeing 9 and 10% inflation on the CPI and PCE again, which obviously would add to the severity of the recession that we're in at that given time. And so we are in some precarious territory now. Now, they are expecting some type of recession in 2025, but outside of the tariff impacts, honestly, I still don't see anything that really makes me believe that we're going into a recession or that we're in a recession right now, even though you hear it a lot. And if the labor market started to weaken, of course that would add to the recessionary pressures. But it does depend on the pace at which the unemployment rate starts to rise. Because remember, we still never had a recession with unemployment under 5.4%. Not saying that that can't happen, it's just never happened. So there was a quote, I don't remember who said this, but unemployment rises like a rocket and drops like a feather. And so if we see a crazy spike in unemployment, you can be sure that we're either going into a recession or in a recession already. And it's the chicken and the egg problem. Is unemployment a lagging or leading indicator? Because the unemployment rate could rise because we have gone into a recession, or it could be rising because it's signaling that we're headed into a recession. So I guess it depends on who you ask. Either way, it shouldn't really matter to you outside of the general direction of your investment strategy. People who tell you that the Fed doesn't matter, I do think they're wrong to a certain extent. They're right and they're wrong. It doesn't matter, but it does. In terms of a general sense of direction for your investment strategy, I think it absolutely matters, especially if you're in real estate or, something that's interest rate sensitive. Because one decision, could make or break you when you're dealing with assets worth hundreds of thousands of dollars per unit. So I shoot these videos in my office, and us here, we're going to continue to do what we're doing on the real estate side in Vegas. And that's regardless what happens with the Federal Reserve, with tariffs. It's just regardless of all that. So I remember another quote. I actually heard this one on CNBC. I don't remember who said it, but he said, I don't know what the weather's going to be. And that's not my job to know what the weather's going to be. But you tell me the weather, and I'll tell you what jacket to wear. So we simply adjust to the environment that we're in at any given time. So guys, don't stress, do nothing but invest. And of course, I'll see you on the next.